Hey, Al Siebes here, and I'm gonna do something today I've never done before. It's a 1-hour masterclass on real estate investing, and I'm gonna document my story, my journey in real estate from $3,000 to a millionaire before the age of 40. I'm so excited about this, and we tried to shoot this 2 other times. Once we were at this great surf break here, and the surf was up, and the wind came in, and looked at the Four-Plex next. Somebody's excited. I think somebody's just caught a wave, but woohoo! All right, so it was a mess and it didn't work. And then we tried again at another surf spot, and I was just wanted to shoot outside, and then this lady was just doing her exercise routine.
You locked up.
Might as well. It's gonna be then with my real estate. And we just couldn't make it work. I'm gonna extract out of this story 3 stages. Stage 1, 2, and 3 that I've got covered up right here, but I'll reveal them as we go. And 4 key principles. 4 things that I want you to take away that were massive leverage. And those are financial minimalism, and I'll unpack all 4 of these as we go. Bank hacking, house hacking, and multifamily. I'm gonna unpack all 4 of those and how we use them along this journey. So here we are. We're in the loft, in the funk zone, near the harbor, here in Santa Barbara, and we're gonna dive in. All right. So let's dive in. We're gonna go over my real estate journey here, and we're gonna start with stage 1. And stage 1, I'm gonna extract out especially financial minimalism. See, when you're getting started in real estate, what you wanna look at is you wanna look at your lifestyle and how much you're spending on your lifestyle and how much you're actually setting aside to save for that down payment and some of the expenses that are gonna occur for you to get into real estate. So what we started out at stage 1 is we started out in property management. And this is my little symbol for financial minimalism. It's like the dollar is less than our lifestyle. So we were being careful. We were trying to reduce the cost of our lifestyle as much as possible, which was extremely difficult because we lived in Santa Monica, California, which is the beach side of Los Angeles. And so to do that, we found an apartment where we could manage the building or be like the resident managers. And I've got a bunch of other videos on how to do that if that's interesting to you. But we managed the building for a group of investors, and they reduced our rent significantly so that we could help them out with leasing. We helped oversee some of the maintenance crews, and that was incredibly valuable experience. Even more than the money savings was just the experience that we got doing this, prepping us for what we wanted to do, learning how to lease units, how to market units, how to show units, how to manage maintenance crews, how to manage repairs, how to prioritize all of those repairs, and how to manage tenants and what their expectancy was of property management. And dealing with all that stuff was such a learning opportunity. It was like a master's degree in property management, which was preparing us for where we wanted to go on our journey of managing our own properties. But it also allowed us financial minimalism, where we were able to take that money that we would have been spending on rent. Now the first one, I'll tell you, they basically gave us $500 off a month on the first gig because we didn't have a ton of experience. But with that $500 a month, setting that aside, if you can force, like literally set up an automatic transfer that goes to your savings account, $500 a month, that comes out to $6,000 a year, and that can add up. And so we were setting that money aside, getting ready for what the next move was. And then we were able to save up to buy a condo. It was our first condo. And this was so scary. And that's where the $3,000 start comes in. At that point, I only had $3,000 saved up. But I just kept thinking, how can I make this work? Because the bank, honestly, the bank messed with me big time. The bank approved me. This was back when the banks were promoting zero down financing. This was actually 2001. And the banks were promoting zero down financing, and we got approved for zero down financing. So I was like, sweet, I don't have to put anything down. And then what happened is at the last minute, they said, no, you actually need to come up with 5% down. And we were buying this condo for $180,000. And this was in the Culver City neighborhood of Los Angeles. And it was overwhelming to us to think that we had to come up with 5% down, because that was $9,000, and that was $9,000 that we didn't have. Even though we were setting aside money, we got to the point where we had a little over $3,000 set aside, and we just didn't have it. And so I panicked and I thought about it, and I started running the numbers, and I realized that I did have some other money set aside for taxes. And if I bought this condo, I talked to my CPA, I realized that I would save that $3,000 in taxes for buying the condo with all of the deductions that came with purchasing real estate. So there was another $3,000. So now I was at $6,000, but I was still $3,000 short. One thing led to another. My grandma ended up having $3,000 that she said, you know what, you can borrow this, and if you don't pay me back, it's fine. I want to invest in your real estate journey. So God bless her, grandma provided that other $3,000, and we were able to get in with a $9,000 payment into this condo. And the condo had great structure to it. It had like 2 decks, 2 little patios, one off the living room, one off the master bedroom. It was just a 1-bedroom condo, but it was cosmetically a mess, like a big mess. But we loved that. It needed flooring, it needed paint. The kitchen was like these old nasty recessed lights. Not recessed lights. They were like these nasty drop fluorescent lights like you'd see in an office building. And we ripped those out and we put in recessed lighting in the kitchen. And then we put in, and I did it myself with a group of friends, we put in the flooring, wood laminate flooring. We painted the kitchen, we did tile. I had someone do that. I didn't know how to do tile. But we did the wood laminate flooring. We just really made this condo nice. And it was a big step for us. It was scary. And we got owner-occupied financing with the 5% down, of course, a great interest rate. And as we were working on that condo, we lived there for over a year. I can't remember if it was a year and a half, or maybe almost 2 years. And then we ran out of money because we'd spent money on the condo, and I was kind of going up and down. I was just getting my real estate career started, and so my income was wildly going up and down. I was strictly on commissions. And so what we did is we went back into property management. But this time, we got a free apartment in property management because we had experience. We built up significant experience managing for these investors, and then even with our condo, I put that on our resume. And so we got a free apartment in the Miracle Mile neighborhood of Los Angeles, and we were able to move out of that condo. And that was a bank hacking situation. So let me define bank hacking for you here a bit. Bank hacking is where you're buying a place to live in, to owner-occupy. You get owner-occupy financing, which is more attractive than investment financing. So a bank, if you're an investor, they're gonna make you put much larger down payment. They're gonna also probably up the interest rate a little bit, because to the bank, it's a little bit more risky to loan to an investor than it is an owner-occupant. As an owner-occupant, you need this place. You live there. The bank views it as lower risk than if it's just an investment and you could, maybe things go wrong and you just walk away. So the bank is gonna favor you on owner-occupied financing. So we got that owner-occupied financing, and then we lived there for a year and a half. Things changed, and we moved out and we rented it out. And guess what? It more than covered itself. It cash flowed a little bit, but we were just totally happy because now we had an asset that was producing income. The tenant was paying down the mortgage for us each month, and we had a little bit of extra cash flow. And that was bank hacking, because now we took a very attractive loan. Now, I just have to give a little bit of a disclosure here. Do not lie to the banks. Do not pretend you're gonna move in and don't move in and do an investor deal. We actually moved in. We did not know we were gonna move out. We didn't know what our plans were. We bought it as owner-occupied financing. Technically, in most bank mortgages, it says you need to occupy the property, but things change. People's lives eventually change as years go by. They have kids or other things happen and they move out. And you can decide at that point, are you gonna sell or are you gonna rent out and hold it? We were buy and hold all the way. I wanted to buy and hold, so we rented that out. We were able to cover that mortgage with a great interest rate, a great loan, with the tenant's income coming in. And now every month that mortgage was being paid, the balance was going down, and that was the start of our net worth going up. Not only that, but we were in a rapidly appreciating market. We were in the Los Angeles market. This was in Culver City. And at the time, Culver City was not as cool as it is now. But so it was an up and coming neighborhood maybe. And that market was rapidly appreciating. What I've discovered is the rapidly appreciating markets are especially the coasts. You could say the West Coast and the East Coast. And those markets in an up market go up rapidly. The demand to live on the coast increases rapidly. Now, there's a shift going on in the country right now where a lot of people are actually leaving the coast and moving to more affordable places to live. But I believe overall, long-term, people like to live where the climate is incredibly attractive and they like to live near the ocean. I mean, it's just proven. You can take a house here in Santa Barbara that's worth $10 million on the beach. Let's say it's a 3,000 square foot house. You can uproot it and move it to the middle of the country and it's gonna be a $300,000 house. It's just because of the demand. People worldwide love to be near the ocean. And so being near the ocean is in a rapidly appreciating market, and that's where we were. And then again, we stepped into financial minimalism. So we wanted to keep our expenses as low as possible, and we moved into a property management gig where we lived in a building. Now in this building, it was 24 units as well, but it had 3 other buildings on the street that were also about 20 something units, and all those combined made it worth it for the owner to give us a free apartment to take care of all those, to keep an eye on them, to help with rent collection, to help oversee maintenance and all of that. And with that free apartment, let's say we would have been paying maybe $1,500 a month at the time for that apartment. That is $1,500 a month that we could be setting aside. If you're disciplined, you just want it to be an automatic transfer from your checking account into a savings account that you set up, that we can be setting aside for the next move in real estate. And also watching our lifestyle, being a financial minimalist. So being conservative in terms of how we buy our cars, how we buy our clothes, how much we eat out, running a budget, tracking that budget, and sticking to the budget. Watching credit cards, being very careful with credit cards and the high interest rates that they charge, and being careful about debt. You see, we were sticking with smart debt. Where we were going into debt was debt that was actually producing income. This mortgage on this condo, that was the debt we wanted. We wanted fixed rate, low interest rate debt that also could produce income to pay for itself and maybe even cash flow as well. And so that was it. That was our journey. It was very heavy in financial minimalistic moves where we could keep our living expenses low and also improve the value of what we brought to the table. I think that's kind of another key takeaway here that I didn't list. Maybe a bonus takeaway is that we were learning and improving the value of what we brought to the table. So here in our first property management job, we didn't have much value. We didn't have a ton of experience. And so we just got paid a little bit. They gave us $500 off a month. Then by the time we got here to this one, we were worth $1,500 a month to this company because we built up experience. So that's another thing you can do is improve yourself, improve what you bring to the table. And that could both be in real estate. I encourage you, get educated, learn as much as you can, get an internship, get experience. And if you work a job, maybe it's not in real estate, maybe there's ways you can improve your skills to also improve your value of what you bring to an employer. Because when you do that, when you improve your skill set and you improve what you bring to an employer, your income has a very, very high chance of improving. And with this financial minimalism, and I'm gonna get even more into bank hacking, but with bank hacking, the higher you can get your income and the higher you can get your credit score, I'll cover that in a second, the better you look to a bank. They literally just want to give you money. You can actually get to the point where banks will fight over you. You can have them bidding against each other. Who's gonna bring you the lower interest rate? Because you are stellar creditworthiness to them. So let's talk about credit score just for a minute. I don't want to get on too many rabbit trails, but it's important here. You want to work your credit score. There's an app called Credit Karma. That's a good one. It's free. You can track your credit. There's other resources you can use. And I'm not going to go into credit scores too much here, but you can track it and you can improve it. And I've helped someone improve their credit score once. They went from like 550 to 750 in a matter of 3 to 4 months. There's ways that you can do it. I'll give you one right now. Get a credit card and just put on it $200 a month and pay it off every month. Just every month for 3 months. Get the balance that they'll give you as high as possible, and then just put a little bit on there every month and pay it off. Very disciplined, and then have as little to no other credit on credit cards as possible. And your credit score will shoot up. You want to get to the point where you can go to the bank and have excellent credit and excellent income, and then you will get an incredible loan at a fixed rate. And I mean, imagine the greatest thing about this bank hacking is, imagine, let's say you want to do a real estate deal, right? You want to start your journey, or maybe you're halfway through your real estate journey and you wanted to do another deal. You wanted to buy a property. And I came to you and I said, hey, you know what? Just find an opportunity and I'm going to loan you 90% of the money that you need. And I'll partner with you on that deal. And you know what? You can keep all of the gain that you get, all of the equity gain. You can keep all the cash flow. Just pay me like, 3 or 4% interest, or just give me a little bit of money every month. And that's all I want. And, and you've got a deal. I'll back you. Wouldn't that be incredible if I actually offered that? And that's what a bank is offering to you. If you can come to the table with great credit and you can show your income, a bank is going to offer to you 80%, 90%. Who knows? They're just going to offer you a lot. I mean, you can even go FHA with 5% down. They're going to offer most of the money, take on most of the risk of your real estate deal, and get very, very little in return. And you get all the benefits. You get all the tax benefits. You get all the equity gain that happens over years, whether that's appreciation or the loan being paid down. You get all the cash flow. You get all these benefits, and all they get is a little return on their money. It's a good deal. And this is an incredible opportunity where you can buy and you can hold, and you are basically hacking into bank leverage big time by doing this. Let's go to stage 2. All right, so let's dive a little deeper now into stage 2. Stage 2, I'm gonna really hit, again, the financial minimalism. We're gonna kind of keep pulling off of that, but we're going even deeper now into both bank hacking and house hacking. This is gonna be really interesting. This stage, we started out with buying a 4-unit, a 4-plex. Now, remember in stage 1, we were in property management, so we were just saving, setting aside money. Well, this property management gig actually eventually started going sideways, and I have another video on that. I won't get into it right now, but it started getting really, really weird. The landlord was spying on us and doing all kinds of crazy stuff, so we had to get out of that. And what we did is we started looking at real estate again, and the condo had gone up in value. It had appreciated over the years. This is, kind of a few years had gone by, and we put a lot into it. Remember on the condo, we redid the floors, we painted, redid lighting in the kitchen. We just did a lot of things to really make it desirable, and we rented it out, and it went up in value. And so what we did is we went to see if we could get a home equity line in the condo to purchase more real estate. And turns out they did an appraisal. Now this is a bank that no longer exists called Washington Mutual. And this is probably why they no longer exist. But they just said, oh yeah, we'll do an appraisal. We're gonna just do like kind of this appraisal where we check things on the computer, and we'll let you know what the condo's worth, and we'll let you know what you're approved for an equity line. So I came back a couple weeks later and they said, hey, great news. We valued your condo and it's gone up in value, and we can give you up to $70,000 in an equity line. And so I said, well, that's fantastic. And so as we were looking for real estate, I want to mention as well, along this way, as I was improving my skills, I got my real estate license. So just in here, after purchasing the condo, I got a real estate license. And that was, again, just improving the skills and the value I bring to the table. But it also was helpful to me because when we identified this Four-Plex, I got to represent ourselves as the buyer, and I got paid a commission on that purchase. So 2.5% of that purchase, which I'm going to get into the numbers here in a second, went to me as income to help pay for the purchase, to help pay for the down payment, to help pay for the renovations and all the things that we were going to do. So along the way here, I got the real estate license. We identified this Four-Plex, and we got approved for an equity line for the down payment. So now let's dig in deep on the numbers here on this Four-Plex. All right, so check this out. On the Four-Plex, we purchased for $700,000. Now with that purchase, we had to come up with 10% down. We were doing owner-occupied financing. So you can still do owner-occupied financing on anything at 4 units or below. Once you go to 5 units, you're in commercial lending. There's no more owner-occupied financing. It's only investor loans. But because this was a 4 unit, which is the most amount of units you can get under owner-occupied financing, we were able to get a loan at 10% down. So it was almost exactly the number I needed that my equity line was providing. So essentially, this is a no money out of pocket deal for me, because this equity line, this is just money that came out of thin air from that condo going up in value. So I now was taking money out of that condo to buy a 4 unit. And when I went into the bank to collect an equity line, they said, no problem, we'll have a check ready for you. I walk in and literally they hand me a check for $70,000. And honestly, this was a time when real estate was booming and people were pulling money out of their homes like crazy. And it's tempting. You get a check for $70,000, it's tempting. It's like, man, I could travel the world. I could, there's all kinds of things this could be a down payment on an incredible Lambo, like all kinds of stuff. And people did this stuff. They took money out of their biggest asset and they just literally blew it on their lifestyle. It's the opposite of financial minimalism. They just went for it and they blew the home, they blew the real estate on stuff that shoots way down in value. Now, I'm not against those things. I'm not against traveling the world. I'm not against if you want to get a Lambo, like go for it, but do it smart. Like don't take it out of your real estate or out of your income producing assets off the things that are going up in value. Don't risk those on your lifestyle. So we did take equity out, but we put it into an even better income producing asset, which is 4 units. So we got that equity line, we put it as the down payment, and then on top of that, I got paid 2.5% of the purchase price as representing myself as the buyer. 2.5% of the $700,000 was mine as a commission that also helped us get into this deal. Now, these 4 units were run down. It's like exactly what we look for, right? Where it's a property that needs a lot of cosmetic work. Structurally, it was pretty good, it was sound, but cosmetically, it was trashed. And so the units were renting for about $750 a month. And one of the units thankfully was empty, so we were able to move into that unit and nearly lost our minds because my wife and I lived there while we were renovating the unit, and it was just a mess. We were like ripping out the bathroom and trying to live in it, and I had a contractor literally show up. And this is why you really want to vet your contractors. You want to get references and everything you can, because this guy showed up, and I still was steep on my learning curve. And I just picked him like off of Craigslist at the time, and he showed up, ripped out our entire bathroom because we wanted to redo it, and then disappeared, literally, for like a week. Like I couldn't get a hold of him. And I thought, oh my gosh, and we were going to the gym, we were going to like 24-hour fitness down the street to shower and use the bathroom because we did not have a bathroom. It was a 1-bedroom apartment in this fourplex. And just crazy stuff happened. And thank God we survived. Thank God my marriage survived this season. It was so stressful, but we learned a ton and we started improving these units one by one. And you know what happened? The desirability of the property increased. It went up and the rent went up. The rent went all the way up to $13.50 over the period of a year of us improving these units. What a jump that was. From $7.50 to $13.50. People really wanted to live in this building. And we lived in one of the units, and there was 3 other units that we were renting out. So the rent jumped up to $13.50 a month. You multiply that times 3, because remember, we're living in one of the units, so we're renting out the 3 other units. This is a true house hack. This is where we are living in a property. We bought it with owner-occupied financing, and we're renting out the other units to provide income to cover as much of the property as possible. Well, guess what happened? When you add those numbers up, all 3 of those units, it comes to $4,050 a month. And you know how much our mortgage was? I'm going to tell you. The P.I.T.I, so that's principal, interest, taxes, and insurance. That's the full mortgage payment, including all of those numbers, came to $3,947 a month. So here we go. We are living for free essentially in this unit because the rent coming in is covering the mortgage payment, the insurance, the taxes, all of it's covered by the tenants in those 3 other units. And on top of it, we have an extra $103 coming in a month. Well, sure, yeah, that's not a ton of cash flow, right? You can't do much with 103. Might have been a date night for Rachel and I don't know, a month, but it's not a ton. But look, we're living in an apartment for free in this building, and that's covering all that mortgage. Now, here's the best part about that. When you run what's called an amortization calculator, so on a mortgage, and you can see how much your mortgage is being paid down each month, it was being paid down $972 a month. So this mortgage balance that we purchased the place, so it was a $630,000 mortgage. That was being paid down $972 a month from those 3 tenants. So when you add that up, all of a sudden it gets really interesting because now you've got $1,075 a month. You multiply that by 12 and you got $12,900 a year. So we're adding in the cash flow of $103 a month, the mortgage being paid down of $972 a month, and we've got $1,075. We multiply that by 12 and we've got $12,900 a year that essentially is going in our kind of net worth. It's money coming in. Now, yeah, of course, the mortgage being paid down, we're not going to see that money until we sell someday or refinance or whatever, but it is actually being paid down every month. So when we analyze this deal as a whole and we say, okay, well, let's say I'm getting the $12,900 a year as a return, and I put $70,000 in, and I'm not including like all these little closing costs, just small amounts I'm leaving out, but for simplicity's sake, and I'm not including that I got paid, I could have taken that out of the 70, but let's just say for simplicity's sake, $70,000 I put into this deal, which again, just came out of thin air, came out of that equity line on the condo. I didn't have $70,000 at the time. When they handed me that check for $70,000, I'd never had anybody hand me that kind of money in my life. And so anyways, I just get mind blown by that. But when we take that $12,900 a year and we divide it by the $70,000 down, so we're at over an 18% return on investment while getting a free apartment. So really, we could even calculate that in. I mean, these apartments are worth $1,350 a month. So that could be calculated in the return as well. And we're going to shoot way over 20, 25% return on investment if we calculate in that free apartment that we're getting. And again, if I'm being disciplined, I'm continuing to financially minimize my lifestyle. I'm taking that $1,350 a month, and instead of just blowing it, I'm going to set that aside for what's next. I'm going to be just automatic draft into that saving account, setting aside $1,350 a month and moving towards what is the next one. All along learning, improving my skill set, both in real estate and my knowledge in real estate and at my job, improving what I'm worth and what I bring to the table to an employer. And meanwhile, my loans being paid down every month by tenants. And on top of that, remember, I've got the condo as well that's being paid down every month by the tenant. You can see how this is starting almost like a rolling snowball sort of effect where momentum is building. It's like the condo every month, the mortgage is being paid down. The Four-Plex every month, the mortgage is being paid down. I have a little bit of income coming in on them. I'm setting aside money every month on the savings that I'm getting from financially minimizing my lifestyle. And this is becoming momentum. But guess what happened? In renovating this Four-Plex, because it was a lot. It was expensive to renovate 4 units. Fortunately, some of the units, we did some different hacks and tricks where we were able to save wood floor, like there was some old wood floors under the carpet, right? So ripped up the old nasty carpet, kind of sand down the wood floors and stain them, and we were able to save the wood floors. That saved us some money. We did other things, but it was expensive to get that much demand to go from $750 to $1,350 a month. We did a lot, and my income was up and down. It was fluctuating, and so what I did is we eventually ran out of money on what we could spend on this, and we decided to rent out our unit 2 and move back into property management to get a free apartment, to just continue moving forward. Now, again, this was house hacking, and we bank hacked because we lived in it. It was owner occupied, and we lived in it for over a year, and things changed and financial demands came in, and we decided, let's just rent the whole thing out and let's move back into property management where we can again get our living expenses low and set aside money every month. And so that's exactly what we did. So now we rented out that 4th unit for $1,350. And what did that do to the income? Well, instead of it being $103 a month, it's going up another $1,350 plus the 103. So we're hitting close to $1,500 a month now in cash flow. And so this was a good deal. And again, we were in appreciating market. This was Culver City as well. So this was close to the coast in Los Angeles, and we were riding up an appreciating market. So I've got all this leverage. I'm heavily leveraged on both these properties. The mortgage is being paid down, and we're in a market that was rapidly appreciating. All these tools. I've bank hacked on both properties. I've house hacked on this Four-Plex. Remember, the house hack is where you've got rental income components coming in to help you cover the mortgage. Here we're covering all of the mortgage. And now what we've done is we've moved back into property management. So we're going back into a little bit of a financial minimalism season because of my income was fluctuating at the time. So we've used bank hacking, we used house hacking, and we're here. Now this property management gig was in Brentwood. It's a great neighborhood, really nice neighborhood in Los Angeles. A lot of celebrities live there. We were in an apartment building and we managed the building. We got free rent. It was that sort of deal. And we were able to set aside that money and it was a decent gig. Like, we lived there for a while. We're getting even better at managing, leasing units, advertising units, marketing units, overseeing maintenance, etc. And then we eventually were ready to move to a totally different part of Los Angeles, and that was Pasadena, California. It's in the foothills just above Los Angeles. And we got our eyes on a 3-unit property. Essentially, it was a house, main house with a guest house. Let me show you that. Now, this is a 3-unit, but essentially the 3-unit was a house. Let me make this a little bit nicer. This is the main house. It had like a cute little front porch, little garden out here, literally had the white picket fence. We lived in this main house. It was a 2-bed, 2-bath, and then it had a guest house. These are not drawn to scale. My drawing skills are horrible, but there was a guest house here with a little front porch, really cute. That rented for $12.50 a month. And then there was a garage that we converted to a studio, because this garage was at the back of the lot, and it was really weird. You couldn't get a car back there. There was no alley. And so it was just a strange situation. So we converted that garage to a studio, and that rented for $800 a month. So this was, again, both, well, you'll see it will become a bank hacking situation, but this was a house hack where we lived in this 2-bedroom house. We bought this whole property for $572,000, and we actually went in 50-50 with a partner. And we figured that our partner, he's a friend, was going to move into the guest house, and we were going to kind of split the 50. So we split the down payment 50-50. We came up with a written agreement between us, and but he ended up not moving into the guest house. So we rented it out for $12.50 a month. But he still stayed as a 50% owner as an investment. And then what we paid is we paid the remainder of the mortgage. So these 2 units, the $12.50 plus the $800, that was $2,050 a month. That covered a little bit more than half of the mortgage. Again, the principal, the interest, the taxes, and insurance, that covered more than half. And so we paid the other half, and then that mortgage was being paid down every month. So we were paying, less than $2,000 a month to own this whole property and experience all the benefits of that being paid down every month. And it was just a great house hacking situation. That property, over the years, started appreciating in value. And we were improving it dramatically. The guest house, we completely redone. I say completely redone. We cosmetically redid the guest house. It was an old 1920s cottage, and so we kind of worked with the look, and we worked with the feel of it. Like, it had these old windows that were wooden and kind of opened in weird ways, and we just kept those. We didn't want to upgrade them to like these cheap vinyl Home Depot windows. We wanted to keep the character, and so we just worked with it and cosmetically improved it and made it look really cool. So we worked on that, and then again, like I said, we built out the studio. The studio, when you're considering doing this, you want to look at how, if I'm going to invest money into this, how quick am I able to get that money back? That's how we approached the studio. So we knew the studio would take about $8,000 to build out. It was just like, basically, it was like 350 square feet, and we added a bathroom, and then it had a little kitchenette. And you know what? That's about $8,000 to do, because we were doing a lot of the work ourselves. And we realized we could rent it out for $800 a month. So we're going to make that money back in 10 months, essentially a year or less than a year. That was a good situation, because we were able to do that, make that money back, and then everything else was kind of gravy, right? It was profit on doing it. And we lived in this property for nearly a decade. And so that really, really paid off. And what happened is then we eventually decided to move here to Santa Barbara, and we moved out of this house and rented this out. And then the whole property was covered. The whole property, the rent covered all of the expenses, and there was hundreds of dollars a month cash flow. And now, so what I've done is I've bank hacked into this because we bought this with a owner-occupied financing. We lived in it for 10 years. And I house hacked because we fixed up the guest house and rented that out, and then added a studio, rented that out, had more than half my mortgage paid for, and then we moved out of it and just completely turned it into a buy and hold, became an investment property. This is an incredible way to build real estate wealth. If you can identify properties that you can move into, that maybe someday you'll rent out, and possibly even have, if there's an opportunity to have multiple units where you can have like a guest studio or something like that, I mean, you can eventually someday move out of that property and it becomes an income generating property. And you can pay that mortgage down over time, and you can own that property as part of your portfolio. And then what will happen over year after year, the tenant's paying that mortgage balance down, the appreciation, even if you don't live in a rapidly appreciating market. Let's say you're somewhere in the middle of the country that does not appreciate quickly. Well, guess what? Even with inflation, the value of real estate at least keeps up with inflation. You're talking about 3 to 5% a year. And now that is just slowly increasing your net worth over time. But it's not so slow if you include the loan being paid down, the appreciation going up, and then who knows, maybe you got some income, you can throw in an extra mortgage payment here and there, and you're just paying it down aggressively till you get to the point where eventually the long game would be free and clear ownership of income producing property. So that's where we're headed here. That's the 3-unit. And that is the stage 2 of the journey, where we had a 4-plex, then we went into property management, and then we lived in this 3-unit. That was an incredible stage where we were utilizing all of these first 3. We were utilizing financial minimalism, bank hacking, and house hacking. And now we're gonna go to stage 3, where we enter into multifamily. Because you could say, oh, well, yeah, well, that's a 4-unit. No, multifamily is where you get into more units. Technically, in the real estate world, multifamily is where you're getting into 5 units or more, because that's where the bank defines a commercial loan for multifamily. And once you get into more units, it really changes the game on your net worth, on your ability to collect income, cash flow, on your ability to have a mortgage paid down by tenants, and ability to leverage. And so let's dive in to stage 3. Okay, here we go. Stage 3, we're going big. We're going big into multifamily. This is where everything, the leverage that we're using, the cash flow, the equity growth, these things just go on steroids. Like, they really take off. And I'm gonna walk you through some of the details. Stick with me here just for a bit. We're gonna go through a few multifamily deals here, and you're gonna see how everything just starts going to the next level. Stage 3. So where we left off last is we were at this 3-unit, right? And we essentially went through the financial minimalism, the bank hacking, and the house hacking. Okay, now we're gonna go strictly into investment property, multifamily. And what we started with was a 12-unit. But let me back up just a little bit, because the way we got into it is we had this condo, remember, our first real estate purchase. And this condo, years have gone by now, so that loan is being paid down every month by the tenant's rent, and it's appreciating. It was in an appreciating market, and that condo had grown significantly in its worth. And so we went to sell that condo. Fortunately, it was close to the peak of the market. I honestly felt like things were just feeling uncomfortable to me. I thought it was something with me personally, because I was not getting a lot of cash flow. I was getting a little bit of cash flow, and I'd had all this equity growth, and so I wanted to make a move to get cash flow. It just made sound financial sense for me to go where I could get more income. And so I started looking in a few other parts of the country. At the time, I was traveling the country and I was teaching with some New York Times best-selling authors. We were doing real estate boot camps, and I was looking at markets. And I originally thought, you know what, I'm gonna try to find a market where I have some friends or I have some boots on the ground, people that know the city and the market, and I'm looking for a market where it's really good cash flow. And so what we ended up looking is in Tulsa, Oklahoma. I decided I was gonna sell this condo because I found a 12-unit there that was in a great location. If you know Tulsa, Oklahoma at all, it was close to Cherry Street, which Cherry Street was kind of like the hip, like coffee bars and restaurants, and it was kind of the spot for that sort of stuff. And I was just right next to that neighborhood, and I found this 12-unit, and it was exactly what I like to do. It was trashed. Now, looking back, honestly, I wouldn't do it again. I don't know that I'd buy a long distance trashed apartment building again. I'll walk you through a few of the things that we went through, but basically there's a whole episode I'm going to devote to this thing called A Gang Moved Into My Property, just to give you an idea. And it was in a great neighborhood. It really was. But again, from a distance, even with a property management company, when you're doing major renovation and you're doing major turnaround, it is not easy at all. But we just went for it. We got this 12-unit. The numbers were so good. I got it for $302,000, and we sold this condo for $360,000. Now that condo, let's say the rent was around $1,250 a month, and we bought a 12-unit with that money. We moved it in what's called a 1031 exchange, so I didn't have to pay taxes at all on the gain, and it was quite the gain. Can you imagine what I would just love to run the ROI on that, right? If I put $9,000 of my money into this condo, I bought it for $180 and I'm selling it for $360, that is a $180,000 gain on a $9,000 investment. That's where real estate is just like, wow, can do wonders in your portfolio. So I sold it for $360. I did a 1031 exchange. In a nutshell, what that means is the money went from selling the property into a 1031 exchange company's account. They're called an accommodator. They held that money and it went into this 12-unit. And there's all kinds of rules you need to follow. There's like this 45-day rule that you need to identify a property in, and a 180-day rule you need to close on the deal you're purchasing to fulfill this requirement. But it's IRS requirements that say that you can sell a property and buy another property without paying gains on the taxes. And they essentially, I believe this rule was passed to stimulate purchasing, because as I purchased this 12-unit, this money's kind of sitting stagnant. I've already done the work. I'm not buying any materials. I'm not employing anyone. We're just sitting there. But once I move the money in this 12-unit, I start spending like crazy. I'm hiring contractors. I mean, the amount of employment and jobs and money that moves. So it's a stimulating the economy sort of thing, but essentially I'm moving this money without paying anything on the gain, and I bought this 12-unit for $302,000. Now, let's dig into the numbers on the 12-unit. A lot of numbers here, a lot of small numbers, but this is where I'm gonna break it down as simple as possible what we did with this 12-unit. We bought it for $302,000. I ran rough numbers, and I'll give you some of those here at the end, where I figured it's gonna be worth about $500,000 when we're done with it, but it needed significant money putting into it. I figured I needed at least about $80,000 to $100,000 to put into it to get things going where it needed to go. But I wanted to get a construction loan. I wanted the bank to loan me on the renovation as well. So what I did is I showed them that it was gonna be worth $500,000. And again, I'll kind of run some rough numbers at the end here. And they said, look, we wanna be in it at 75% LTV, loan to value. The bank always is looking out for how do they keep themselves protected. And so if you're saying it's gonna be worth $500,000, we're gonna send an appraiser to verify this, but that means we will loan you up to 75%, which would be $375,000. So they're gonna give me another about $75,000, really $73,000 towards the renovations in a construction loan. I still had to put my 25% down on the purchase. So I'm kind of simplifying this a little bit, but basically they want to just make sure they have that cushion, that 25% equity cushion for the bank along the way. And if the numbers make sense, they'll approve you for a construction loan. Certain banks do this. And then the construction loan, it's usually like a little bit of a higher interest rate. And the way this worked is I would do work on the property, I would submit my receipts to the bank, and sometimes pictures, or they would send someone out to check the work, and then they would reimburse me on the work that was done. We went in stages. They didn't just give me $75,000 and said, yeah, go for it, work on the property. It was more something where there was accountability all along the way, and they cut checks according to the work that I'd accomplished, and they verified the work was accomplished. Again, the bank's always thinking of how they can protect themselves from something going wrong. So let's look at the monthlies on the rental income and the income coming in on the property. The one bedroom's rented for $400 a month, and there was 9 of them. Now, yes, $400 a month seems low, but again, we bought the building for $302, and Tulsa's a very affordable city to live in. So rents are low, but also the prices reflect that. So $400 a month. I knew I could get more. These were small one-bedroom units, but we knew we could make them nice. But regardless, when I bought it, they were about $400 a month. There was 9 of them, $3,600 a month. Then the 2 bedrooms were renting for $500 a month. There was 3 of them, that's $1,500 a month. The total rental income was $5,100 a month. Now, just that alone is a huge jump from that one condo, right? We sold a condo that was $1,250 a month and bought a 12-unit that's $5,100 a month. Now, a lot of these people, this was a rundown building, and a lot of these people weren't paying the rent. Most of them weren't paying the rent. And I mean, I had situations, I'll explain one to you right now. It's kind of crazy. It's called cash for keys. But I had a situation where I had some people in there that were pretty unsavory characters. I'm sure they were dealing drugs. I'm sure there was criminal activity going on. And so I needed to get them out. And I didn't want to go through the whole eviction process of waiting months and trying to get them in court and all of this stuff. So I approached with what's called cash for keys. Now, I actually had a private security guard with me when I did this. I'm not just going to walk up to these guys and offer cash, but I essentially said this. I said, hey, look, guys, I've got my security guard with me when this happened. And I said, look, guys, here's the deal. We want to renovate this unit that you live in, and we actually really need you to move out. And this is what I'm going to do. I know it's a pain to move, so we're going to cover your moving expenses. We're going to give you $350 cash if you guys can be out by this weekend. Does that work for you? And these guys were like, yeah, that works great, because they knew, like, essentially the way I described it is I talked a little bit more and I said, hey, look, we know you're behind on rent. And I said the landlord, I didn't say I was the landlord. I said the landlord wants to essentially evict anyone that's behind on rent because they can't pay their bills. And they just bought this building and it's expensive. There's a lot of bills to pay. And they're going to give money to a judge to evict you. Or I can actually give you even more than we'd give to a judge, get you $350 cash if you can be out this weekend. Does that work for you? And they're like, yeah, that totally works for us. And so sure enough, we just said, look, when you're out, I'll come back, and I'll have the security guard with me. Or heck, I'll just send the security guard. I don't even need to be there with the $350. Make sure the place is empty. They get the cash. It's called cash for keys. And it's beautiful. And so, yeah, sure, we could have spent maybe $180 and gone through the whole court process, but it would have taken months. And it was the time. And also just the building was brought down by these guys kind of doing drugs and doing their thing. And it just brought the whole thing down. And I've got units I've just renovated that I want to rent out. And we'll get to those rental numbers now. So now with the improvements we're doing, I've got the 1 bedrooms, we're going up $45 a month. And I know that doesn't sound like much, but hold on. It's going to make a lot of sense here. You multiply that by 9, it's $4,005 a month. Then the 2 bedrooms, I'm going up $65 a month, making them nicer. And I've got 3 of those, so that's $1,695 a month. Now our rental income's gone from $5,100 a month to $5,700 a month. Again, not a massive jump, but look, $600 a month is $7,200 a year. $7,200 a year. Now that's not bad, right? But look what this does to the value of the property. And this is a way you can kind of value rental increases is you divide by what's called the cap rate. And I can't go into, you can just Google cap rate, or we'll have other classes, or I'm gonna eventually have a real estate course here that I'm gonna release that will go into more of the calculations and more of the numbers. But for speed's sake and simplicity's sake, trust me, you can divide the income here. So this income increase is $7,200 that we're increasing by the going cap rate that these properties were selling for. It's about a 7 cap, okay? That would increase the value of this property by $102,857. So just by my increases of $45 a month on the 1 bedrooms and $65 a month on the 2 bedrooms, making them nice, making the property more desirable, improving the curb appeal, I'm actually going up by more than this. Just on the income, I'm going up $103,000 almost in value. Now that's not to mention just the desirability. There's other things that go into valuation like price per square foot, price per unit, desirability of the location. But that increase in value, you can see how by having multiple units, it dramatically affects the leverage, where small increases in desirability in the property, small increases on rent multiplied by the number of units can, just on a 12 unit, that is a significant jump in price. I mean, that is 30% of the value of what I bought the property for. That is really incredible. And so this property did go up in value. It went up well over $102,000. That was just on the income. But when you include all those other factors I just described, we actually went up in value over $500,000. So that was the 12-unit property. So we'd sold this condo and moved the money into a 12-unit income-producing property. Then we got our eyes on the 4-unit, and we thought, well, that 4-unit's also gone up in value, and the tenants have been paying down the mortgage every month for years now. And we thought, you know what? It's not producing as much income as it could if we went into a larger multifamily. So we sold the 4-unit and we bought a 48-unit, a 48-unit fixer. And this time I tried to buy in Tulsa, Oklahoma, because I really encourage people to keep their portfolio in the same location, but I couldn't find something that was in a good enough location where the numbers made enough sense, and I found something in Texas. This was in Victoria, Texas, which is a mid-sized town, and I knew someone there on the ground that told me about how nice the area was, and it had a university, it had all kinds of employment, it had oil money, and so we thought, you know what, it's a diversified economy there, it's a good-sized town, and I found this 48-unit. Now, part of the trick to finding it, I found it off the market and I got the seller to finance the deal. The way I did that is I searched title. Now you can get title searches. There's different ways you can do it online. You can research that. I don't want to go into that too much, but I searched title and I pulled title records for everyone in this city that owned over 30 units. And it came out to about 150 something owners. And I wrote a letter, we typed out a letter, and I had myself and someone working with me hand wrote every envelope. Oh, and Joe, thank you so much for helping handwrite those envelopes with me. So we did that, we sent them out and we got a great response rate. And of the 7, 8, 9 owners that called me back, one of them I figured out could not only sell the property, but potentially seller finance the deal. And this is how we approach that. So I've learned with seller financing, when you're the buyer and you're wanting to see if a seller will finance you, to use big numbers. Not avoid interest rates, use numbers, cash. What's it gonna be in their pocket? Because we needed a win-win. I needed them to get a win out of this for this deal to happen. And they told me their price. This is the 48 unit. So on this 48 unit, the price the seller was wanting was 1.8 million. And you know, I was looking at comps and looking at the price, and the price was okay. It was just milled. It wasn't like great. Wasn't getting an incredible buy, especially for the condition of the property. It needed a lot of work, and it was 25% vacant. And so it was being mismanaged. It needed a lot of work, and I was just unsure of how to make that happen. But also, I knew at the time it would be very difficult for me to get a bank loan for this property. This was still, this was as the real estate market was in major transition in 2007. And I knew a bank loan would be very, very difficult for me on a $1.8 million purchase. So what I did is I proposed to them, I said, hey, seller, how about I pay you $78,000 a year? You can be the bank. I'm gonna give you your price. Well, let's not even talk about price. I'm gonna give you your 1.8 million and I'm gonna pay you $78,000 a year. I want a 10-year note. I'll pay you $78,000 a year for 10 years. And then I'm gonna give you your 1.8 million. So you're gonna get your 1.8 million plus 78,000 a year, and you are just the bank. You have no responsibility in the property. It's pure cash flow to you. Sounds like a good deal, right? It was. It was a great deal for them, and it was a great deal for me. Watch how these numbers break down. So they're financing me, right? And I'm paying $78,000 a year. That's $6,500 a month, right? Now, let's look at the income of the property. Oh, and I also put $270,000 down. So let's talk about that before I go into the income. The $270,000 down was from the Four-Plex. We purchased the Four-Plex for $700,000. Years had gone by. The mortgage had been paid down. We went to sell the Four-Plex and we sold it for $970,000. That's $270,000 that we had in equity. I'm just simplifying the numbers. I'm not including there was other money with the mortgage being paid down, and yeah, we put $70,000 down. So there was more than that. But essentially, we took that $270,000 out of here. We did a 1031 exchange again, so we didn't have to pay taxes on the gain, because we could have had to pay like 40-50% tax on that when you add it all up. So we didn't pay any taxes. We took that whole $270,000 and we put it as a down payment. But that was not, a bank would have required much more than that down on this deal. And so that was not even close to what a bank would have required. It was a great deal for us. So we gave them $270,000, and then they also got from us $6,500 a month from there. Okay? So the income coming in was 2-bedroom, 1-bath units, all of them. All 48 were 2-bedroom, 1-bath units. And it was $525 a month. There's 48 of them. That's $25,200 a month in income. Now, my mortgage payment is $6,500. Now, that's not all gonna be cash flow. And the other problem is, remember, the building's 25% vacant. So honestly, when we first bought it, we were making a lot less than this. And on top of that, it needed so much work. And I didn't have hundreds of thousands of dollars sitting in my bank account to renovate it. So what we did is all the income that came in above our expenses, we dumped it back into the property every month. And meanwhile, we were again living a financially minimized lifestyle as much as we could. And we were taking all of our extra and putting it into this property and investing it back in so that we could get this vacancy way down. So we were renovating units that were sitting empty. We did not want units sitting empty. So we'd renovate 1 to 2 at a time and then rent them out. And then as people moved out of the other units, we'd renovate them and rent them out. And as we did that, what happened with the demand on the property and the rents? Well, it went up. People noticed, oh wow, they're making these nice. And the rents went up. We increased rents from $525 to $575 a month. You multiply that by 48 units. Now you're at $27,600 a month in income. So rents went up between the 25 and the 27. They went up $2,400 a month. So we dropped this vacancy low. We got the units improved, and rents went up $2,400 a month. That's $28,000 a year. So on $28,000 a year, again, if we go back to that example of how we can calculate what that does to the value of a property, when you divide it by the cap rate of what properties are selling for in that area, that $28,000 divided by a 7 cap was $411,428. That increases the value of the property by over $400,000 because now we're dealing with 48 units. So even a small difference in income on a unit, when you multiply that by 48, this is only a $50 difference in income per unit. I mean, if you have 1 unit, 2 units, 3 units, 4 units, you increase rent by $50, you don't really notice it that much. But if you increase rent on 48 units by $50, you are now looking at an increase in value in a market where properties sell for a 7 cap. Again, it depends what the cap rate is, but you are looking at dramatically increasing the value of a property. And that's where numbers can really make a difference. And you can imagine a lot of multifamily players, they want 100 units, 200 units. I have some people that I work with, I work as a real estate agent, that want to look at properties that are only 100 units or more. And I get it. Like, I understand. It's like they want the leverage. They want to increase, when they increase value, when they increase rents, rather than just doing it on a 20 unit or a 10 unit, they want to do it on 100 or 200 units because it creates a dramatic increase in value in the property. If you take 100 units and you increase rent by $50 a month, it's dramatic what it does to the property. So value started going up, both on us forcing the value, that would be called sweat equity. We're actually forcing appreciation on the property because we're improving it, we're improving the desirability, we're improving the curb appeal, we're improving the inside of the units, and we're improving the value. So it's the value based on income. So income's going up, and then the price per square foot, price per unit, desirability, and not to mention that over time in Texas, this property appreciated. And you know what we even did? We even took a few of these units, and they struck oil in the south of Texas, and we took a few of these units and we furnished them. And we put the rent at $1,200 a month. So I took a $575 unit, I spent a few $1,000s on furnishing it, and then I put the rent at over $1,200 a month, furnished unit, and they started getting booked up. We actually had an oil company just literally write us a check direct from the oil company to say, hey, our engineer's coming down. We have 2 engineers going to stay in a 2-bedroom, each gets their own bedroom. Here's a rent check for 6 months at $1,200 a month. I mean, we just booked them, and so then we'd eventually furnish another one. We got to the point where we had 12 units furnished, all at $1,200 a month. And you know, that dramatically, again, affects the cash flow. That also affects the value, but banks, sometimes on furnished units, they're a little more hesitant to give as much value to a furnished unit renting for they just won't give as much value to a furnished unit renting for $1,200 a month as they would to just the normal market rent being $1,200. But it's still increased the value of the property, dramatically increased the income on the property, and that's what we did there. So we owed $1.53 million on this property after you take out the $270,000 down payment and some of the other things that went into this. And then we ended up selling this property for $2.4 million. There was $870,000 in equity in that property. So if we go back, we're at the 48 unit here, and we summarize where we're at in the journey. But as I was approaching 40, we had the 48 unit at about $870,000 in equity. The 12 unit here that we just walked through all the numbers at about $250,000 in equity. Remember, we bought it for $300, but again, we put a down payment in it. It was worth over $500 when we were done with that work. Then the 3 unit here, the house with the guest house and the studio, had 250,000 in equity in it. That all totals up to 1.370,000. Now again, that 3-unit we were a 50% owner, but even if you take that out, we are well north of $1 million in equity on these properties. And again, we did that by using these strategies, leveraging heavily into keeping our lifestyle conservative financially and investing into properties where we could bank hack. We moved into it, we made it home, we lived there for years and then eventually moved out of it, rented it. We would house hack, where we would move into a property and have rental incomes, rental components coming in and helping pay for that mortgage, which then when you move out of that, you can rent the house that you're living in or the apartment that you're living in, and then the whole property pays for itself and provides income. And then eventually moving into multifamily, where the leverage was huge, where you increase each unit that you increase income in, when that increases across the board, you're now leveraging, you're using like a power tool to leverage your equity and increase your equity, increase your income. And you do all of these things and it becomes a rolling snowball. It is where real estate becomes just a catapult for wealth building over a long period of time. You have to understand, this is a long period of time. This is almost 2 decades, I'd say 15 years. Over that period of time, real estate continues to grow and build wealth, even if it's just keeping up with inflation. Again, some people say, well, I'm not in a rapidly appreciating market. Well, you're in a market where a tenant can be paying down the mortgage and even a 3 to 5% gain a year starts significantly adding up. So that is it. That's the journey. That is the story. That is starting with $9,000 and ending up with over $1 million in equity. I'm so glad you got to be a part of this story and journey with me. And I'm hoping to release some courses here soon where I can go into much deeper detail for those of you that want to on specific topics. But thank you so much. If you've enjoyed being part of this, please subscribe. We're updating videos every week. Give us a like button, and thank you so much. See you on the next one.